Really excited for this month's meetup. I'm excited for every month, but especially this one. The Northwest Arkansas Commercial Real Estate Meetup was started by Misi and myself 13, 14 months ago, as a goal to try to get the commercial real estate community here. Those who are in it, who are in the thick of it, are in it every day. Those who are 1 foot in, 1 foot out, someone who wants to get in it full time, who wants to just invest and sit back and learn about the process. So to do that, every month we started this meetup to try to get excellent speakers. More recently, Misi has been doing some of the networking sessions, which we didn't have a chance to at this time. I saw some people networking. That's like one of the big goals here is for people to get out there and do deals together. So I'll tell you a little bit about myself, Brian. With Elevate Commercial Investment Group, we buy multifamily properties across the country. Love buying them here in Northwest Arkansas. There's only so many you can do here. So we're all over the place. I found that out myself through 6 years of investing here by myself and with friends and family and small multifamily before partnering with Elevate. So now I'm focused on helping people passively invest, helping people get deals done. So my partner, Misi, reached out to me, I guess 14 months ago to start this program. And, I'm really glad that you pushed it forward and got it to this point, helped it organize, keep it tight and organized. And even every single month, we're talking about how we can improve this meetup, keep bringing you guys better speakers, make this experience better for everyone. So we're really excited about the future here. And I'll let you introduce our speaker today, Mervin. I actually ran into Mervin on Saturday morning flying out of Washington, D.C. So of all places, where do you see Mervin at D.C.? So, I was in Cincinnati visiting family for Mother's Day weekend, and my connection was in Washington, D.C. And I see Mervin waited for the XNA flight right there. So he's doing whatever he does in Washington, D.C. And that can tell you somewhat of his credibility and status that Misi can dive further on.
Definitely. And I think we'll start in September 2022. So
September
3 months.
That's why we got you.
Close 2 years. So pretty big milestone for our, somewhat small market where you can run into someone on the plane.
Yeah.
And a little about myself, my name is Misi Leo. I'm a commercial real estate investor here and also nationwide. I mostly specialize in passive investing, business partner, and I specialize in books like seasoned executives and also business owners in helping them replace their multi-six-figure income, just like on my business partner, Great State. So we really specialize in high asymmetrical return with relatively low risk type of deals. And I already talked about the meetup, so without further ado, I just want to introduce our speaker. But before that, I'd like to welcome our Waco title, our sponsor, to come and talk about, how they made this even possible and just talk about them as well. Darren, would you like to come?
I didn't realize I was going to be speaking tonight, but my name is Darren Owen. Some of you guys know me. I'd like to get to know all of you as soon as possible. I'm in part of the Waco Title Commercial Closing Department, and we have Matt Philpott here. He's another closer from Waco, and I've been in Northwest Arkansas since 1990. I moved up here for my sophomore year of college. I was also born in Fayetteville, so I call myself a native since I've been here longer than Fort Smith, which is where I grew up from 2 to 20. My background is I have an accounting degree and went to law school, and I was in-house counsel at Cooper Communities over here for many years, and then managed to sell real estate for about 5 years. So for those of you all who are salespeople, I know what you go through. It's very challenging. And this job at Waco opened up recently. It was a perfect fit for me. And I would look forward to having the opportunity to close any transactions that you guys can send our way. So thank you very much.
Thank you, Darren. Thank you. So thank you with the title for making this possible. And it's actually with the commercial division as well. So it's pretty cool. And Mervin, she's the director at the Center of Business and Economic Research at the University of Arkansas. He's well known for his work related to the Skyline Report for artists as well. And also he has many titles. A few of them is Arkansas Business 40 Under 40, Arkansas 250 list. And he's also very close with other policymakers and related to economics, really research as well. So I would love for Mervin to come up here and add on to anything before he talks about today's big topic, commercial real estate market.
That's good, thank you.
I'll pull up the slides for you.
That's it. I run the Center of Business and Economic Research at the University of Arkansas. I forget which one it's mine. And we have done real estate research in Northwest Arkansas since 2004. So the 4 times before things got bad, we were studying things. We saw things before they got bad. We saw things after they got bad, and we're seeing things now where they are largely pretty good unless you're a buyer. Thirdly, I'm going to talk about the national economy and how that plays into what we'll talk about commercial real estate. That'll give us an opportunity to look at what's going on here, contrast that with what's going on nationally as well. So you've probably heard something about the economy. A lot of people have different opinions about the economy. So before I start talking, I guess I should take a poll just to see where you guys are at. How many of you guys think the economy is doing well? I mean, nationally, yeah. 3, 4, 4, 5, 5. I feel like an auctioneer here. 6, 7. About 10 of you or so. How many of you think the national economy is doing poorly? No one? How many think the national economy is doing middling? But the rest of you? Okay. At least in this audience, you don't have too many thinking the national economy is doing poorly. When I talk to a lot of general audiences, it's like, oh, national economy is in the tank. It's terrible. Very few people think the economy is doing well. I'm here to tell you that for now, anyway, the national economy is doing great. There are a few issues here and there, but by and large, the national economy is doing great. So if you're looking at this chart, this is the overall economic growth in the United States. Going back to just before the pandemic, you see the pandemic and distortion right around the pandemic. And then since then, we are tracking GDP growth that is stronger than what we had going into the pandemic. So before the pandemic, our usual GDP growth on a year-over-year basis would be about 2%. A great year would be a year we've done better than 2%. And an average year would be a year we did somewhere between 1.8 and 2%. So before the pandemic, CBO, IMF, World Bank, Congressional Budget Office, whoever was forecasting the US economy said that, at this point, 2023, 2024, our economy will be growing about 1.8%, and we should be very grateful for that. What we've done instead, in 2023, we grew 2.5%. It's a little bit stronger than 1.8%. And we're forecasted to grow about 2.3% in 2024. So if you're looking at this chart here, it shows you the last several quarters of GDP growth here. You'll see that the last one there is 1.6, so it sounds like we're declined. And you might have seen that in the news when they released the GDP forecast, estimate for the first quarter of this year. But if you look at what exactly goes into the GDP in the United States, you'll see that we're actually healthier than the 1.6% forecasted. So this is the headline rate, 1.6% growth in the first quarter. And this has all the different components in it: consumer spending, business investment, residential, government spending, net trade. That's the difference between imports and exports, inventories. The next bar over here basically takes out inventories. So that's the stuff that companies buy and hold on to be able to sell to you in the future. We generally discount that when we're looking at GDP metrics because those tend to be fairly distortionary in the sense that companies buy and sell inventories in large quantities. And we don't care so much about the inventories they're holding as much as whether they're selling it or not. Now, for example, inventories stayed positive for a long period of time. That means there's a problem because companies are buying a bunch of stuff and not being able to sell them. The issue here is that an inventory adjustment actually went down. So the company sold more than they bought. So that's not a problem. So then you get to here, we take out the trade component. So as you might think of this, if consumers spend a lot of money, we import a lot more things and we spend money. So if we spend a lot of money, we're importing a lot, which means imports get subtracted from our GDP. So you take that piece out, the far right there, that bar shows you close to 3% growth. That is the domestic economy. That's you and I, businesses in the United States, and government spending together. About 4% of the US economy, or just under 3%. And you take out government spending as well, that growth will be 3.1%. So if you just looked at consumers, residential investment, business investment, as 3.1%, which is very different than the story you might imagine if you just looked at 1.6%. The largest reason why it's 1.6% is because, and we've had previous months where the trade has been a positive addition to our GDP, but trade is a very small portion of our GDP. It's less than 10% of our economy compared to other countries where that may be a very big portion of their economy. So this is basically US domestic demand. It takes out all of those different components that I've told you about, and you're looking at everything that's just the US economy. And you'll see that other than this brief period here, right after the Federal Reserve started raising rates, mostly we've seen very strong growth in the US domestic economy. The reason why it's been very close to negative or negative on a few quarters It's because right after the Federal Reserve started raising rates, there was a dramatic slowdown in residential investment. And as you'll see, if you go further to the right there, residential investment is coming back, which is part of the reason why you see this 3% domestic US economy as a residential investment has actually picked up nationally. So there was a very significant pause last year as well. I mean, it was picking up slowly last year, but at this point, people have gotten used to the higher rates. I don't know if we've gotten used to the idea that the rates are going to stay higher for longer. We'll talk about that in a little bit, but residential investment has picked back up. There's more inventory coming on the market, both multifamily, single family, as well as commercial properties. And so that's the US domestic economy. I'll come back and talk about some other components. And I want to show this other chart, which is us compared to other major economies. And let's see that we went into the pandemic not outperforming the rest of the economies around the world. We've come out of the pandemic outperforming almost every other country, at least major economy out there. So we're doing better than most everybody else. Keep in mind that we spent a lot more money than these countries to get out of the pandemic. They don't quite have the ability to borrow and spend like we do. We paid for some of this with the higher inflation that we saw and are seeing to some extent. The difference is they didn't they didn't spend a lot of money to get out of inflation, but they still had all the inflation that we had as well. So if you had to pick which one to be, would rather be, we paid a lot of money when we got inflation, we at least got out with really fast growth. They didn't spend a lot of money to get out of the pandemic. They still got the inflation and they have more anemic growth, which is a concern. As I said, trade is not a big component of our economy, but most of our trading partners. So for some companies, this matters a lot, especially if you're making airplanes and things of that nature, cars, and you're trying to sell them to other countries, people in other countries. They have a lot less buying capacity than US domestic consumers at this point. So that is a concern to some export-related businesses. The other big problem is that if you've traveled abroad recently, you'll know that the US dollar is incredibly strong. It's the strongest level in several years. I was in Spain recently. The dollar-euro conversion is very good in my favor. I'm going to be in Japan later this month. The currency exchange rate has not been this good since 1980, the US yen conversion rate. So a lot of people are traveling as a result of this very strong exchange rate. A lot of your friends are probably traveling this summer and finding that their money stretches a lot further. Problem with that is people trying to buy our goods are not going to be able to afford as many things as they have in the past. It also means that foreign tourism coming to the US is dramatically declining because they can't afford to come here since the US dollar is so strong. So that's some always the other side of some very good news story. This is the broader rest of the economy here, and you'll see again, I put all the categories back. And so this is the overall GDP over a longer period of time and all those different categories. I like that residential investment is in red here, so you can clearly tell where residential investment declined right after the Federal Reserve started raising rates and where it has started contributing positively to GDP and a lot more positive contribution in the first quarter of this year than we had previous. The bedrock of our economy, however, is the dark blue portion. This is consumption spending. This is you and I going out and spending money in the US economy. We continue to spend money in the US economy regardless of our feelings about the economy. So most of you thought that the US economy was middling. Most of the broader public thinks that the US economy is doing terribly. This hasn't affected their spending behavior. Consumers are still going out and spending like drunken sailors. And for as long as they're able to do that, the US economy is on firm footing. You'll see that the mix of what we're spending money on has changed. We're spending less money on goods, more money on services. So more of you are going to events like this and spending less time sitting at home and ordering stuff online, although that is happening as well. And so the little sidebar here on services, if you went out and bought food at a restaurant, that is a service you've engaged in. The difference is a lot of people are not necessarily going to restaurants, they're on DoorDash. So it still counts as restaurant spending as service sector, but you're really actually sitting at home and eating that food. So a key thing to remember there. When I say we're spending like drunken sailors, this is my evidence for it. The dotted line is our pre-pandemic spending trends. So we thought the economy was doing well before the pandemic, and it was doing well before the pandemic. That's the level we were spending at. Since the pandemic has happened, we're spending more money, and this is adjusted for inflation. So no, it's not because everything costs more money. It's adjusted for inflation. We're spending more money today than we did before the pandemic. So we're actually going out and buying more goods and recently more services as well. And that's what's driving the US economy. And if you're wondering, do consumers really have the ability to spend all this money? The question a lot of people ask is, has credit card debt gone up? This chart shows you revolving debt for US household, and you'll see that, yes, it has skyrocketed recently. So this is not adjusted for inflation. This is just level change. Your eye is obviously drawn to two different things. This one is the drop in debt loads immediately after the pandemic. That's because the federal government sent cash to a lot of households, and households turn around and pay their debt. So you see an immediate drop off in debt loads. The other big jump is here, which we'll ignore. That is a rule change when the federal government started requiring banks to report things like home equity loans and stuff under revolving credit. So there's a one-time level jump there where they had to report other things. So if you look at this on the far end of the chart, where I guess all of us are, and we turn and wave to the camera, you'll see that it's at its highest level. But if you adjust for their disposable income, you'll see that we're not at the highest level. In fact, we're spending about as much on credit cards as we were somewhere in 2014. Then the economy wasn't right. It was just then coming out of the recession. So this is the total revolving debt that you saw in the previous chart, divided by disposable income. This is your income after you've paid taxes and after your transfers, etc. So as a percentage of your disposable income, this is one of the lowest levels we've seen in a long time. Obviously, the levels were much lower immediately after the pandemic, both because your disposable income went up suddenly because the federal government sent you a chunk of change, and also because you used that to pay your debt load down. So at the very end there, you see consumers still have the ability, disposable income has gone up. So the other thing, the flip side of all this inflation that we've seen is that incomes have been rising very fast in the US. So consumers, how are they spending all this money if they're not putting on credit cards? They actually have this money. Something like 50% of US households have less than 20% of their credit balance used. So they're only using about 20% of their credit limit. Less than 10% of households are using any 90% of their credit limit. And those households tend to have much smaller credit limits. The median, the 10% of households using 90% of their limit usually have a median credit limit of about $5,000. So it's understandable that they're using most of that $5,000 credit limit, but over half the households are only using about 20% of their available credit limit. So consumers are in a very healthy position, and telling you that they have a lot more room to spend, a lot more room to even borrow on their credit cards. Not that they need to, but they do. And the reason why consumers have all this money is because the employment growth in the United States has been very robust in the last couple of years. We have finally started seeing a little slower employment growth, but every time we see a little slower employment growth, it jumps back up. So I'm very reluctant to say that 175,000 jobs is the new normal. We think that the normal neutral range of employment growth in the United States is about 150 to 170,000 jobs each month. So if you're looking back over time, we basically beat that by about 50 to 100,000 jobs each month. So we're growing faster than simply neutral employment growth, which is why you see wages growing as much as they have. Before the pandemic, again, the neutral employment growth in the United States might have been about 100,000 jobs each month. That would be the amount of increase in employment without changing the unemployment rate. So right now you're seeing the unemployment rate again hold very steady, and we're growing about 175,000 jobs, but on a 3-month average, it's only 250,000 jobs each month, because you have the first 2 months of the year were incredibly strong, and that followed on from a very strong last quarter in 2020 as well. So the reason why we have this much stronger employment growth and why we think the neutral has moved from 100,000 to 175,000 jobs is because we've had very robust immigration to the United States in the last couple of years that has grown the size of our labor force significantly, but we're able to absorb all those workers, which is why the neutral has moved. The unemployment rate hasn't changed, and you see this much job growth. We wouldn't have had this much job growth without that level of immigration because there simply aren't that many people here, and there are kids here, but most people don't have a lot of kids. And that is just a generic secular trend here in the United States. If you're on a university campus, they'll tell you about the enrollment cliff coming in 2025. That's just because my peers, elder millennials, like myself, have had either no kids in my case, or one kid, which is about half or a third of the normal range of kids that people have had. So without this immigration that we've seen in recent years, we wouldn't have this labor force growth. We certainly wouldn't have this robust economy that we're seeing right now and people's ability to spend. Again, the growth is not concentrated in any particular industry. This chart shows you how many of the private industries are seeing employment growth. You'll see that it's about 60% of industries grew employment for the last couple of months of data that we have. It reached 80% right after the pandemic. So obviously right after the pandemic, everybody was rehiring. That makes sense, but the employment growth is still very robust. It's not in one sector. It's broadly across all the different employment sectors and years. And again, this is just private sector. It's not include government data or government employment. And then finally here, this is employment wage growth in the United States. So going with very strong employment growth and low unemployment rates, because very strong wage growth. Again, before the pandemic, we were very lucky. We got the 2% wage growth in the United States. Today, we're casually doing 4% month over month average wage growth in the United States, which is obviously contributing a little bit to inflation as well. People have higher wages, they have more money to spend, and that keeps our inflation rate fairly high. And you'll see for most of the last year and this year, the wage growth has been faster than the pace of inflation, which is what that green line is. So people's wages have been growing faster than inflation. So there's obviously this period of time here when inflation is well ahead of wage growth. So people are still sort of feeling the leftover effects of that in some part, but over the last year anyway, we've seen wage growth beat the rate of inflation, largely because inflation itself has come down because of various supply chain kinks being worked out. And then finally, this is the unemployment rate. This is the headline unemployment rate. And if you're looking at this line, the unemployment rate right now in the US is 3.9%. It has been under 4% for 27 months. The last time that happened, President Nixon was in office, and we had just landed on the moon. We at least faked a landing on the moon. I was at the Smithsonian this weekend, so I saw the moon lander. It's real. We actually did it. Anyway, there are burn marks on it when it came back. I don't think they faked it. I don't think CGI was that good back then. It's still pretty bad. So the unemployment rate being this low is fairly incredible. Not had a period. So those of you that lived here in the 90s, that was the previous best economic time we've had. In many respects, we have outpaced the 90s economy right now. So, and you'll see with our unemployment rate being this low, our labor force participation rate is the highest it's been in 2 decades. So this chart here shows you the labor force participation rate for the population between 25 and 54, which is what the blue line is. So at 25, you're likely no longer in college, even if you've taken the 8-year path to get a college degree, you've graduated by now. And at 54, you're not quite at retirement age yet. And if you're looking back all the way to here, that is the highest labor force participation rate we've had in 2 decades. And in the intervening 2 decades, the labor force participation rate for that group came down significantly. And this entire period, we spent a lot of time, money, resources trying to figure out how to get more people to work. As it turns out, running a really hot labor market with high wages is the way to do it. So all the billions of dollars we spent on workforce training programs and stuff to get people back to the workforce, none that actually work or give people more money.
I see no other work.
Yeah.
I see 2
Yes.
indexes here, which is which.
The 80s is the 25 to 54 portion. We do not want people over 55, 80% of them working. That means something terrible has happened to our retirement system. So you'll see on the other side, the lower numbers here, that is the population above the age of 55, which we'll talk about some more. But basically, the bulk of the working age population has seen the highest labor force participation rate across every category. We've had also the highest labor force participation rate for women ever in the United States. Men, not quite as much yet. So there clearly still some people just playing video games at home or whatever, but women are the highest labor force participation rate.
I'm just curious on the data that you have.
Yes.
Do you think was that a possibility because COVID happened? So all the folks just changed their priority, they just retire early? Because it's a sudden drop from that starting 2020.
You're talking about the gray line, 55? Yeah. Yes, that is one explanation. We'll talk about that here in a second.
You're looking at it.
Not pointing to you. But obviously, everybody's labor force participation rate declined here.
Yeah.
But the increase in it has largely been driven by the fact that the wages are so strong. The wage growth is so strong, the labor force participation rate for every category. And you don't see here, it's population above the age of 16. So if you talk to parents Those had teenagers at home before the pandemic. You were very lucky, and it was very rare if your teenager went to work. Now, teenagers that go to fast food restaurants, Sonic, Andy's, wherever you want to go, a lot of teenagers are working the drive-through windows. That's because the wages are so strong, even for teenagers. They're getting $18, $19, $20 an hour. So they're happy to, well, I don't know if they're happy to work, but their parents have taken that extra step, driving them to work, and then driving them back after work. Kids don't drive these days either. So, but the kids are probably okay with farming because you work for 2 hours, you can afford a new video game. That was not true before the pandemic. You'd have to work for at least 4 hours to get those. The labor force participation rate, even for 16-year-olds, is fairly high. And so this is the retirement age. So that chart here, if you look at this, it looks very misleading. It looks like, people have above the age of 55 are retired dramatically. What you need to remember is that we have the largest population of retirees ever. This is baby boomer generation retiring. So if you adjust for the fact that there are more baby boomers than there are other generations right now, then the age adjusted labor force participation rate is still fairly good. So this is the labor force participation rate if you did not adjust for the fact that baby boomers make up a significant portion of the US population. This is the labor force participation rate for 55 and above, if you account for the fact that baby boomers are a significant portion of the US economy. And if you're looking at that chart, it's very close to pre-pandemic peak. So yes, people retired during the pandemic early, but by and large, 55-year-olds, those above the age of 55 are still back to pre-pandemic levels of labor force participation rate. So people that are retired are those that are well above 65, usually closer to 70 years of age. And then they're staying out of the labor force. We saw some of them come back when right after the pandemic, when inflation shot up and wages shot up, they needed to come back to work, but the stock market has done so well. Treasury bonds are also doing so well. So there's really no need to go back to work when your portfolio is doing so well. So this is the unemployment rate in Arkansas and Northwest Arkansas. The Northwest Arkansas unemployment rate is about 2.5%. In the state, it's about 3.6%, which is just slightly lower than the federal unemployment rate right now. So we've had an incredibly good year in Northwest Arkansas and in Arkansas as well, as far as the unemployment rate is concerned. Now, obviously, it's not very even all over the state. There are places that have much higher unemployment rate. Hot Springs, Pine Bluff come to mind, and then places like Northwest Arkansas have much lower unemployment rate than the rest of the state. So, and then finally, this is business. So we've talked about consumers, talk about business some, and we'll talk about real estate investment here in the next few slides. But this is business investment in the United States. You'll see that it's been positive for a very good chunk of time here. This is roughly when the CHIPS Act and the Chips and Sciences Act and the Inflation Reduction Act and several of those federal government bills passed, the bipartisan infrastructure bill. All of that basically had a good chunk of change available for private industry to invest in the United States. And as a result, you've seen significant amount of new factory construction and new equipment purchases here in the United States, which is why business investment are really strong as well. So put together a really strong employment market and very robust business growth, you get incredibly good productivity. So we just talked about how, people have more money, they're spending more money, businesses are spending more money, and somehow inflation keeps going down. Not going down as fast as we'd like it to, but it's going down. And the reason why it's going down is because we're more productive than we were before the pandemic. So the only way we can continue this pace of consumption, both as individuals and businesses, is because our productivity has increased dramatically. Again, blue line shows you our productivity stats before the pandemic. Dark blue line and where we are today. We are the most productive economy in the world right now, these strong major economies. And the reason for that is very much related to two things. One, you see in this chart here, where businesses are investing in these two things, structures and equipment. This is the ability to produce more goods. So they're investing in capital. And if you remember some introduction to economics class you had, is one of the sources of economic productivity is capital investments. Businesses are investing in capital here in the United States. The other reason why we have incredibly good productivity is because workers found better matches for their employment during the pandemic. So before the pandemic, the labor market was fairly hot, but not as hot as it has been since the pandemic. So during the pandemic or right after the pandemic, you heard of the Great Resignation. People just quit their job and then search for another job, which is usually not something people do. People usually find a job and then quit their job. But the labor market was so hot during the pandemic that they just quit their job without having another job in hand. And then spent time looking for another job. They didn't just take the first offer coming to them. So what this does is it gets better matches between employers and employees, which means employees are more productive because the job they found, because they took time to find a job, suits them better and they're working better at it. Also because the labor market was so hot, employers are reluctant to let go of workers or lose workers. So employers are investing in training for workers to keep them longer, offering better benefits, working conditions, working hours, flexibility, hybrid work schedules, et cetera, et cetera, et cetera. So workers are happier at their jobs, which makes them more productive. So between the two ends, we have the most productive US economy we've seen in a very long time, which means that we can go out and spend as much money as we want within reason and not have inflation because we're productive with the looking at this economy. Which brings us to inflation, which unfortunately is still fairly high. So the most recent inflation figures in the last few months anyway have disappointed. We're still at about 3% inflation. The Federal Reserve is at 2% inflation. We'll talk about that in a little bit, but this is basically the month-to-month changes in inflation decomposed with all the different categories for a variety of different reasons. But I put this up there to show you there are only a few things the Federal Reserve can do. The Federal Reserve has rates as high as they do right now, and the rates can affect some of these things, but not all of these things. And some of them you don't want them to affect as well. So let's look at some of these things like used cars, which are still elevated. Car prices are still really high. In part because cars have changed. Today's cars are not what you could buy 5 years ago. They're suddenly more technologically advanced. They have a lot more expensive components, and the starting price for cars is much higher than it used to be. It doesn't help that the car makers don't make small cars anymore either. All the cars are big cars, so they cost more money. Used cars obviously are very related to the new car market, so used car prices are high because new car prices are high. Airfare, hotels, car rentals, people have a lot of money. Okay, and they like to travel when they have one. So all those travel-related categories are showing high levels of inflation. Again, because the job market is so hot, if you tried going to hotels recently, you might find that they're very strongly encourage you to not have them come in and clean your room every day. And if you ask them to, they probably won't anyway. That's because they're having trouble finding workers to take those jobs because they'd much rather take higher paid jobs somewhere else. So again, travel is very impacted by how much money people have. Energy is not something, again, the Federal Reserve can do anything about. We're producing more oil than we've ever produced here in the United States. Doesn't seem to matter. If there are tensions from the Middle East, oil prices will go up, which is what has been true in March. Oil prices are down. Just driving up here, I saw it was under $3 again per gallon. So, for now, tensions, at least in the Middle East, are just on college campuses and not in the Middle East, apparently. Anyway, the headline inflation is everything else other than shelter, which I'll talk about. So this blue part is what the Federal Reserve is probably really targeting. They can't do anything about travel expenditures. They can't do anything about cars. They can't do anything about energy prices. But the overall inflation is still fairly high for a variety of different, I'm going to say, in my opinion, esoteric reasons, because they're not, reasons that are systemic in our economy. There's just every time you're trying to figure out what's happening, there's like one odd category that's popped up. Most recently, in the first quarter of this year, has been because the stock market's been doing so well. The people that take management fees on stock market performance can see their service fees go up. That's because the stock market is so well. That's not a bad thing. And that contributes to inflation because that category of inflation has gone up. Also recently, and this is a problem, car insurance, so those of you that renew your car insurance, it's suddenly everything costs a lot more money. And home insurance prices have gone up as well. Car insurance has gone up for the same reason that new cars and used cars cost so much money. Everything in your car is now more expensive. I don't know, I still have a dumb car, I guess. It doesn't have any of those bells and whistles. And so if I had a fender bender, I could just look in Kentucky. Today, if you buy a new car and you have a fender bender, it broke like 20 sensors in there and it cost $5,000 to fix. So everybody's car insurance prices have gone up because your cars are supposedly so much smarter and therefore cost more money to fix. Which also means they total cars more often with just minor, what previously would be considered minor and easy to fix. It's just now too expensive to fix. They don't bother. Home insurance prices have gone up significantly as well. Part of this is related to construction costs going up because construction labor costs have gone up. But also part of this is because we've had incredibly significantly more incidents of, natural disasters, whether that's on the coast, so you have hurricanes or cyclones or whatever, in the middle part of the country, fires or tornadoes or whatever else. Basically, home reinsurance prices have gone up significantly because you've had so many more claims because of different kinds of natural disasters, and we're seeing that here as well in Northwest Arkansas. I have a very high risk tolerance. I used to take the most deductible they'd ever give me because I assumed, well, if my house burns down, fine, I can pay the full deductible. What I wasn't accounting for is that how often we get hail now. I put a new roof that I paid for myself because it didn't meet the deductible. And then the next day, huge hail comes down. I'm like, come on, it didn't damage it, it was brand new. But, it really makes me rethink my deductible strategy here. But we're having that, and as a result, home insurance prices are likely to stay fairly high. Health insurance prices have probably gone up as well. Again, during the pandemic, a lot fewer people used healthcare services for a variety of reasons. A lot more people are using health services now. Again, with baby boomer population retiring, they're going to use a lot more healthcare services, so those prices are going to go up. So again, the dark blue portion is going to remain fairly stubbornly high. And then finally, the shelter piece will come down. That's the orange piece there, but it's not coming down fast enough. And by the time it comes down, it's probably going to go back up, which I'll talk about here in a second. So the shelter piece is calculated weirdly in inflation metrics. Yes.
If I can just interrupt
Yes.
you real quick, because I'm thinking that, we talk about commercial real estate
Yeah.
investors and the level of macro background and where we talk about, which is all very important, right? Because you have to understand macro before you get into the details. I would love to know kind of what people are working on from a commercial real estate standpoint, because I know you got a lot of slides to cover, so we may dive into some more than others as well. If you guys are, investing in or working with these multifamily, if you can raise your hand. Okay, how about like industrial? We work a lot with industrial, we have a couple, which is very hot. Any hotels related, or hotel, office, property management, like couple office. Okay, so that gives you
Yeah.
an idea of the room, because I know we're moving to
Yes.
about the real estate specific.
We are getting to real estate now. So
Like up on the real estate content.
So really, the single family rent index here is not what goes into the inflation metric. What they have there is owner's equivalent rent, which is basically includes single family rents, but also for those of you that own homes, the inflation metrics figured out what your rent you're paying is, which is not your mortgage payment. It's what rent you could get in your house and assume that you're paying that. And there's a long reason for doing that, but that's how it's calculated. But because of the way they do that, it takes 12 months for changes in rents to go into the inflation metric. So rents peaked in the United States in 2022. They've since declined dramatically in other markets, but it peaked in the inflation metric only in 2023 and has a ways to go before you can. So nationally, rents are going down anywhere from 1 to 2% or going up 1 to 2%. Right now in the inflation metric, it is not there, but eventually it will get there in November of this year. So that's how long it'll take for this orange piece here that's contributing to inflation to go away. So that's why we'll continue to see higher levels of inflation than we've seen in the past. That will go away eventually. The concern that we have here is that it's taking so long to go away. And the federal interest rates have been so high that building has slowed down in the United States, which means that just as this is going away, the rents are going to start going back up because we're not building enough because rates have been so high. So it's a two-edged sword here with the Federal Reserve keeping rates as high, housing is contributing a lot to inflation. It doesn't get solved because we don't build enough housing. So then this is a problem that doesn't go away. So speaking of interest rates, the Federal Reserve is committed to its 2% inflation target. We're unlikely to hit that target this year. We're unlikely to hit 2% much of next year as well. So at some point, I guess somebody has to answer the question of whether we should still keep the 2% target or not. I'm in favor of canning the target, but that's not the majority opinion. I said this in a meeting with US Treasury last week and almost got laughed out of the room. I would like to point out that the 2% target only came out in 2013 or 2012. And the only reason the Federal Reserve said a 2% target is because they were struggling to get there. And they didn't get there ever until the pandemic. Only the pandemic got them to 2% inflation. So I don't think there's any reason to be married to a 2% inflation target, especially since we had a whole decade when we could not get there. But as a result, the 10-year treasuries are still fairly high. The 10-year treasury is projected to end this year at 4.2%. So the mortgage rate, if we think of the premium on that, you're still expecting significantly higher than 6% mortgage rate. This was a survey of economists that I chair. This came from the February survey. I asked them this question again in May, they changed their minds. Like you see here, in February, they thought about 55% thought that at the end of this year, our mortgage rate would be between 6 and 6.5. Most of those guesses were close to 6.5 and 6. So keep that in mind. Today, if I'd asked them the same question, then yes, that most people 7. Again, the 10-year treasury is staying at 4.2. 7% mortgage rate is probably where we're going to land at the end of this year. So at some point, home buyers are going to change their minds about how they feel about this high interest rate. But so far, they haven't shown any appetite to change their mind in any significant way. Which brings us to home sales in the single family market. So we'll talk about multifamily here. What we talk about in single family is going to be very important. I still think that when people move to Northwest Arkansas, they're looking to buy something. That's one of the reasons why they move here. And the fact that the multifamily market is as hot as it is because there isn't a whole lot of single family sales happening right now. And so this shows you sales of single family homes here in Northwest Arkansas going to the end of last year. And even if you look at this going through April of this year, you'll see that the home sales levels are back to 2017, 2018. Now, those of you that were in single family residential side, the 2017 and 2018 were really good years for real estate in Northwest Arkansas. They're obviously not as good as 2020, 21, but we're never going to get to 2020 and 2021 levels. Those were abnormally high because the interest rates were abnormally low. We're not going to get to 3% mortgage rates for 30-year mortgages. And we probably don't want to get to 3% mortgage rates for the 30-year mortgage. If we got there, it's probably because some financial crisis happened. The Federal Reserve had to cut rates as much as they did, so we don't want a financial crisis either. But overall, home sales, if you told me in 2017 that this is a great market, I probably believed you. We said that we'd have the 2017, 2018 residential market all the way in 2024. We have all agreed that that would be a good thing. But then we had this thing between 2020 and 2021 when the market just went crazy. And everybody has their levels set at 2020 and 2021 and the volume of sales then, we're never going to get that back. We should let that go. We're not going to get 2020 and 21 sales. Again, if you're looking at national home prices as well, we had a dramatic decline when mortgage rates shot up significantly. The national home prices are climbing again as well. So population of the country has continued to increase. During this period when home prices dramatically dropped off nationally, did not happen here in Northwest Arkansas. Builders stopped building. What happens when builders stop building? People, population continues to demand pressures prevail and home prices are starting to climb once again in the United States. This is the picture here in Northwest Arkansas. We have slowed the rate of home prices, but again, there was a time when nationally we went into negative on home prices. We did not achieve that feat here in Northwest Arkansas. Home prices never went negative. They simply slowed from 30% all the way to 4.5%. On a year-over-year basis. So we're still showing very, significantly higher sales prices here in Northwest Arkansas. Not any significant decline. Again, Madison County, they had about 60 homes sold in half a year, so it's not a very big market there. This is an affordability metric, again, on the single family side, and we'll talk about why this matters in multifamily. The median price of the house and median area income for a family of 4, which is about $94,000 in Northwest Arkansas. And the median home price in Benton County is close to $400,000. So basically, this is the median home price divided by the median family income for a family of 4. You'll see some improvement there at the end. It has nothing to do with home prices. It has everything to do with the fact that incomes went up significantly. So over here, the median family income for a family of 4 was $64,000, where it is today $94,000. So the improvement you see in affordability is not from home prices, it's from people's income. Same story in Washington County, very high median income, $350,000. Median home price, again, same $92,000 for a family of 4 is the median area income. And you can see there's slight improvement there, nothing to do with the home prices, everything to do with that. And then finally, we're not seeing as much, there's not been as robust building as there has been in 2020, even in 2022 in Northwest Arkansas, but we're not seeing people building houses and not being able to sell them. In fact, the bigger and bigger chunk of single family sales come from brand new construction. It's at its highest percentage in our report, which goes all the way back to 2004. So we're probably going to say that this has been its highest percentage ever. 40% of all home sales are new construction. And before the pandemic, during the pandemic, it used to be 25, 26, 28%. Now it's 40%. It's basically a good chunk of the inventory is brand new construction, and people are buying brand new construction because in very many cases, builders are offering buy downs on their rates. Standard 30-year mortgage rate is 7.25%. Your builder might get you 6%, which is very appealing to a lot of people to get into a house right now. So the other side of that is that people who don't have to sell a house are not going to sell a house, because if they're going to sell a house and live in this market, all they're getting at this point is an increase in their monthly mortgage. Because home prices are low, but you can't sell a house, buy a house cheaper, and the mortgage rate is higher. The payment has not changed. Home prices have not gone down. So if you sell a house and buy a house, the payments will go up by more than $1,000. So as you each month. So as you might imagine, people are not willing to make that trade. So this is the other reason why people aren't happy about it. They're trapped in. Yes.
Would you say the supply curve is like on positive for single family housing, or is it still in negative overall?
The question is, are we producing enough housing for the people here? No. There's, I think, in the year 2019, Northwest Arkansas produced enough units of housing for all the people that moved to Northwest Arkansas in 2019.
So if we're in a negative supply curve, how are you determining the elasticity of the housing supply?
In terms of what people are looking to do.
Yeah, like, because eventually they're always talking about how we're in low supply, it's just pushing up rates and rates, but eventually when do we reach a equilibrium of supply in a market like this? Is there a way to like project it overall, or do we have a threshold that we think we can hit in Northwest Arkansas before we hit a peak? Or is that something that's too hard to determine?
The question is, when do you think the demand will meet the supply?
Yeah, because if it's really, like, if we hit the supply immediately, some people are saying, oh, well, we're just gonna plateau, stuck there. I've heard some people say, well, we got population growth, so we're gonna keep growing. But in my line of work, I hear both sides of it, so I'm kind of interested on your.
So the problem that we have is that we've never built, Northwest Arkansas population started growing into the previous recession in earnest in 2014. We, in any of those years, with the exception of 2019, we never built enough housing for the population moving. So we were always working with the deficit. We're still working with the deficit. The problem we have now is that the population growth in Northwest Arkansas today, in the last 2-3 years, is stronger than it was before the pandemic. We were adding 11,000 people each year before the pandemic. Now we're doing 13,000, 13,500. And we're not building anywhere near enough units any year to accommodate all those people. So for there to be where prices don't change, it would take us building significant quantity of housing just to catch up with all excess demand. The flip side of all that is to say that there is a limit to how much you can see rent increases, and we'll talk about that for multifamily. Because at the end of the day, people moving to Northwest Arkansas expect a certain lifestyle. They're not going to pay San Francisco rents or Boston rents to live in Northwest Arkansas. They want to reduce their costs. So that's the other side of the push of the demand side.
That's what I was
So
gonna
the rents keep climbing, and at the pace that they are, that would be if you don't then reduce. Rents are climbing because you're not producing enough, but also because the development costs are significantly higher. So if you don't reduce development costs in Northwest Arkansas, you can't build enough housing for comfortable prices. That will affect our population at first, because people won't want to move here. Because yes, we have a really great location, but we still don't have big city amenities that other people have. And people are willing to trade down some of those amenities for much lower cost of living, but they're not willing to trade down for the same cost of living. Speaking of multifamily, this is our vacancy rate here. They had the numbers at the bottom, but unfortunately it's disappeared. Fayetteville has the lowest vacancy rates. Bentonville and Rogers currently have the highest vacancy rates in this report. And that's largely because we're tracking about 1,600 units added in the last half of the year. 600 of those units are vacant when we measured it. It doesn't mean it's vacant right now. And that pushed vacancy rates up in those cities where those units ended up. But by and large, your vacancy rates in every market are under 5%, which is incredibly healthy. And it's probably much closer to 3 and 2% if we count those brand new units that went in some of those markets. The Fayetteville market is practically full. The by the bed, which is where a lot of the vacancy used to be, is actually less than 1% vacancy. Some of that vacancy might be units that probably never been rented because there's some issues with them. The university is directly contracted with several of those by the bed university toyed with the idea of buying some of them, but decided against it. As they're directly contracting with the buy-to-let units. So basically, you pay the university money, and the university gets you a room in one of these buy-to-let apartment complexes, which infuses me because by the university when you expect a certain amount of rule following, but that does not happen because there are no RAs or any regulations in those private properties anymore. But that's the state of the play, and the university is currently looking for developers to put two dorms. For a whopping total of maybe 700 units on campus, so that's drop in the bucket for how much. Keep in mind though that the university is not going to grow at this pace forever. You're going to see a new freshman class that is going to be large. They won't. I can't nail them down to a number yet, but it's probably going to be larger than what we have right now. The university is not going to grow endlessly. As I told you, there is an enrollment cliff coming because people do not have children, so therefore they don't have enough children for college. But the university is likely not going to grow at the pace it is growing right now. If anything, it's going to grow or stabilize at the high, it's at 32,000 students, I think, right now. So probably flatline around 33,000 students, but not decline. Some of the universities in other parts of Arkansas, for example, University of Little Rock, University of Arkansas, Little Rock, or UCA, UAFS, unfortunately. You'll see significant enrollment declines at those universities. We might see enrollment declines in the community college here as well. But the big flagship schools, University of Arkansas, Arkansas State University, Jonesboro, and they see enrollment declines, but they're not really growing as fast as that. So this vacancy rate will, in the favorable market at least, will work itself out over time when student population stops growing as fast as it has. That's it. That what with Bobby Petrino and John Calipari here, all of a sudden our athletic program and our baseball program is really good. I think more students want to come here, so I could be wrong. Maybe the enrollment decline will not happen. More students will come here. You guys need to remember that before Alabama became great, they were a very small school. They've had such incredible enrollment growth because the athletic program is so good. People coming from all over the country. Maybe to Tuscaloosa, Alabama is not a great place to live. But it's from Tuscaloosa that is not better. People move to Tuscaloosa because they want to be part of a winning athletic. I don't know if they're going to be a winning program anymore, though. But anyway, that's neither here nor there. But soon, for example, that our athletic program could end up doing really well. That might actually get people to move here. Those 2 years when we did really well in the March Madness, we saw a huge spike in applications to the university in March. I told the enrollment services they should be worried about students applying in March and not admit them. But university likes students. So I don't know if you're going to apply based on how a basketball team is doing in March to go to school that fall. I'd be a little worried about whether that student is committed to the academic side. And then our basketball team didn't do well. And then they'll come back now. The Northwest Arkansas rents are, as I said, nationally rents went down 1 to 2%. Some markets like Austin, well, more than that, 7, 8, 9%. There were a couple of months where Austin was showing 10, 11% rent declines. Ours is up 9%. We've now hit over $1,000 in the average rent. Now this includes everything. Julie goes by the beds, which tend to drag the average down a little bit because you're buying 1 out of 4 bedrooms for $700 or $800. But the average rent in Bentonville is about $1,200. The average rent in Rogers is about $1,150. In Bentonville, you take out by the beds, 1,000. Springdale is $960-ish. Silent Springs is the only place you can find a bargain, but you're now 45 minutes outside the corridor. I think at least from my house it is. The rents are about $700, which is kind of where we used to be, 5 years ago, which we're not anymore. And again, so to your point of how much more of this can we tolerate? I think if we continue building brand new apartments that are all in the $2,000 rent range, we'll see vacancy rates go up. I think the people moving here have the appetite for significantly higher rents than we're seeing.
2,000 per single bed.
Well, for either 1, 2 bedroom. We can handle some of those. Obviously, people like some luxury, very close to downtowns, a lot of amenities, but that's not the overall market.
Clearly, we're growing very
Yes.
quickly. Are you seeing that rate of growth moderating a little bit in the last several quarters or not?
No, the home price sales went down, but this went in the opposite direction because people are moving here and they're waiting to buy a house because they think the mortgage rate will come down, which I'm here to tell you the mortgage rate's not coming down anytime soon. So you quit waiting, but they're waiting But they think, oh, well, I'll come back at 5. And some people have misguided notion, they'll come back at 3.5, not happen. But they're willing to wait, so they're renting. And because we're not building enough rental units. So just to give you an idea, nationally, we're gonna be building 750,000 units in multifamily space. We expect 4,400 of those to be here in North Shopping Center, that's under construction. Get approved North Shopping Center. And, these are, and there's another 18,000 or so units that are announced. These might be permitted, not permitted, simply announced, but no activity has happened. There's another 18,000 units out there that could happen sometime in the next few years. But right now, about 4,400 are under construction that will come on this year. Which, considering how small we are in the national economy, 4,400 is set.
And that's where you see the spread between class A and class B or C. How's that changed?
All the stuff coming online state.
Right, so what's happening in rental rates? You can do, B and C really picking up.
I think GNC is picking up, unfortunately, so they're not stable, they're making increases. Again, the flip side is that I don't think people are moving to North Shopping South to rent forever. So there's a threshold of pain they're willing to endure, but depending on the kind of apartments you bring to markets, if you end up spending a lot of development and you need to charge 2,000 a month, I would worry. If you can charge 2,000, you need to charge 2,000 a month.
Yeah, so I mean, basically, the beginning of that used to pretty much say a multifamily developer could not do wrong, but caveat there. You're like, a developer could go wrong with too high of rents, maybe not underwriting vacancy high enough,
Yeah, so you can charge 2,000, you probably get away with it right now. I'm saying that if you were gonna depend on 2,000 in your pro forma, and you need it to be 2,000 and can't go down, then I'd worry also that your vacancy rate would be higher than what you're seeing market by 5%, it would be 8 or 9% if you maintain the rents that high. So yes, the overall market vacancy rate is really low, because this includes every kind of apartment on the market right now, so. But I could be wrong, maybe people coming here have a high tolerance for high rent, but I just think that most people, if you ask people, there are routine surveys, people know the apartment value, ask people what kind of lifestyle they want. They may not want to own a huge house with a huge yard, but they basically want to own just like we do. And maybe they'll own condos and they'll build.
Do you expect any softening in Class A rents over the next couple of years as all these new units come online? Do you expect at some point they're all trying to lease up at the same time? And, your neighbor starts offering a month free concessions, and you have to do that, and that kind of starts going down.
I do expect that, in the high, not all Class A is not priced similarly. I know we call them Class A, but they have a huge sort of range of rents on the higher end, and that have to start offering incentives. We did have a period right before the pandemic, but markets, the single family market was doing so well, everyone was buying, that rents in multifamily were holding flat, and then apartments were offering 1 free month rent or an Xbox or something like that, which is weird trade to make. But that's the classic price discrimination. You can always get a college student, 1 month's rent can pay for 2 Xboxes, so you can always get a student with 1 Xbox. Not very smart. Hopefully when they leave. Any other questions on multifamily before we start talking?
So 1450 chunk rent in Rogers, we're at A class, you think you'd be all right? Theoretically, 200. They need bidder on the corner of.
Define A class.
Depends on where, Rogers is a huge place.
That's right.
The other side of the mountain, downtown Rogers. And then probably not, so. I mean, I think in general, the ones that are close to the amenities, the ones that are on the corridor, are gonna tend to do, I see people build apartments out in the middle of nowhere, I'm like, okay, better be cheap, which they were, so they still, they rented up, so. But there's all kinds of new stuff, we've seen huge build to rent subdivisions still on, so far they seem to be doing well, but eventually made people who want to buy some of those, I don't know if they are convertible or not. We currently have single flat. I think the middle end of the apartment market is still very sound. If I worried about anything, I'd worry about the very high.
You had feelings about condos. Could you expand on kind of why you don't think they're being built here?
There's been a variety of different explanations for why we don't build enough condos, and I think the federal government, we met with Fannie Mae and Freddie Mac that trying to come up with different underwriting standards on their end to make, the mortgage rate you could get on condos fairly comparable to ones with single family unattached housing. I think that is some inhibitor, but I think the other big piece of that is just, I don't know if it's cultural or that we had some brief period of condo building which coincided with the previous housing crash here in Northwest Arkansas, and it soured everybody's mind on condos in Northwest Arkansas. So those few that were here in 2006, 2007, condo was the next big thing happening in Northwest Arkansas, and then almost every one of those went under. So that's kind of what happened with TIF districts in Northwest Arkansas and Arkansas in general. Like everybody else uses TIF districts except us. Just because one huge project failed, and now like we won't touch that thing again. So kind of, I think it's that, but I think the underwriting challenges. So you can get it, well, now you can't get a cheap mortgage in anything, but you could get a cheaper mortgage on single family attached housing, maybe put it on attached pieces. But in other places in Austin, in places that we are quickly becoming like people buy condos, people buy attached housing. It is a good chunk of the market there, and we're gonna need that. We're gonna need that mix. We don't have space to build single family and detached housing for everyone moving here in Northwest Arkansas. We just haven't gotten to that level yet. Probably doesn't help that the zoning standards in our cities haven't changed in any significant ways since the 60s and 70s. That Rogers is changing very soon. Rogers has 31 or 33 different zoning types. They're gonna go down to 12 or 15, I can't remember, something like that. And then Bentonville is probably gonna do the same thing.
Hallelujah.
Huh?
Hallelujah.
Yeah.
What do you think of downtown Rogers? There's not that much more that down, it built better. It's built there. Definitely downtown, it's down, battle a little bit. Yeah, what do you think of the market down is going to look like in downtown?
I would expect that to do really well because the retail development in downtown is extremely well. It is one of my favorite downtowns in Northwest Arkansas is the mix of restaurants and businesses that you get in downtown Rogers. It's really good. They have a lot of good public space as well. That has been their challenge is that they don't have people living downtown in downtown Rogers. But that is a challenge. So I think with the new zoning that they're doing online, probably will likely see a lot of tear downs. There are a lot of old buildings there, a lot of broken up concrete lots and pads that are very easily well.
Are there any subdivisions you feel like has higher potential than others in for development?
I think when we look at the subdivision market, I look at the ones that are doing really, they've shown higher levels of vacancy than it really has to do with building base. There's still going to be a lot of subdivision development for this country, but it's really going to be the future of our housing strategy here on the front side. Single family housing subdivisions, the number of people who.
Too much Springdale doesn't get talked a lot about with all
Yes.
the downtown resurgence going on. What do you see kind of happening there? I guess on the retail and stuff.
So I think the issue in Springdale is that the area of downtown that you have a lot of developments in downtown is going, you'll see a lot of families that are again downtown, see those well. From the retail perspective, east of downtown is where there is quite a bit of land that you could build on, but the sewer capacity there is not where it should be, and I think the city is looking into that right now. So I come on, they see a new sewer project, they need a pump station. The cities that have to make that investment, because you can't vouchers to do that. But the city is an initial phase of planning for that right now, so try to figure out, what the cost of each of the eventually make. They did it, should make a lot. Several different technologies, they have the job they have, so that's what's going to happen. I'm going to sewer license. So if they do the sector planning, they would sewer testing, straight out to a lot of the eastern side of downtown, you have any similar events. But that's a few years, sewer project forever.
Yeah, getting into like different submarkets, what do you think about the impact of the Walmart home office being completed in 2025 and for the Bentonville submarket? And do you have any data tracking new people coming in for that specific area?
So you might have seen in the news today, they've had some layoffs, but attached to that layoffs was the other announcement that they're closing some offices in other locations in Dallas, etc., and offering relocation packages to move here. Again, sometimes those tend to be a different form of layoffs. I don't know that everybody is going to take the relocation package and move here. Some just decide to quit and take the severance and find another job in that market. Again, Atlanta's a really good market to be in, really great, strong economy, and so is Dallas, so it's not like people are struggling to find work in Atlanta or Dallas to some extent, so. And that might be more like the things that Tyson did, where those in Chicago and Sioux City, and say move here, people move. So, I don't know, actually, it's probably several months down the line to figure out, but.
I heard
They have announced that they want more people to come into the office, so they're changing some remote work. People that were fully remote are probably gonna have to at least come to a hybrid situation. So you'll start to see some more movement towards Venable from that, because they have the people that were given permission to work fully remotely, and they're hopefully in some very probable time enjoying themselves while they're working. Now they don't have to move to Venable, which, to be fair, is great weather. Yes. That sort of answer your question?
Yeah, and a follow-up question, like on some markets, you have Fayetteville, Springdale, Bentonville, and now Rogers. Do you see any of these other submarkets getting kind of in their own category that you're
So
trying?
the other big thing that is likely to happen here is Rogers, once they build that little connection that takes you directly through to the home office, will suddenly make all of that area the new interchange. I don't know what exit number it is, but will suddenly make all of that area within like 10-15 minutes of the Walmart headquarters. So you'd expect to see a lot more housing action there as well.
Is there like a top line, resistance where, say, somebody's looking at acquiring a multifamily property, there's room for rent growth by $100 or $200 per unit, depending on interest rates and the cap rate, but, whatever the appraiser values at, somebody's eventually gonna say, there's no way I'm gonna spend $50 million on an apartment complex in Northwest Arkansas, I'd rather buy it in Dallas or Florida or something of that nature. Like, even though
We're spending $50 million right now.
well, yeah, but I didn't know if we can get to a point where they're like, well, if you build it out that big, there's just no way somebody's gonna be able to offload it. Just because of the total price point.
I think the kinds of institutional investors you're seeing come to Northwest Arkansas still not as much a bargain as it used to be, but they're still willing to spend here. And I think I've talked to a few of them about the market here, and their issues, they can't find something to buy. Not that they're not willing to pay the asking, they can't find a project there.
So the commercial market sectors,
Yes,
multifamily, industrial, warehouse, office, retail.
commercial, yes.
If you were going to invest today for a return in 3 years, which would you pick?
Warehouse. You see that orange line there, warehouse vacancy rate? It used to be 0. And then one warehouse came online, which at the time of this report hadn't leased out yet, so really one warehouse is available. So if you had capacity, I'd be in warehouse, that'd be the quickest return you'd ever see in this market. Again, very related to the fact that publicity and open by itself and stuff. When you more warehouses. In fact, that's where a good chunk of those storage facilities are basically operating as warehouses. Why there's incredible amount of storage facilities everywhere in Northwest Arkansas, which people, if they're moving from big coastal areas, they're moving from smaller houses to bigger houses, they don't need storage space. So.
Yeah, just not following up on that question about, warehouse, would that be a good bet for the next 3 years? So we talk about the economy, it's pretty good right now, but there's also a lot of talks about, a delayed soft landing or hard landing, et cetera. And when that happens, it's just a matter of how they swing cycles. Warehouse would be impacted a lot or not, opening it because consumer spending would be significantly lower. We don't buy as much stuff, so there's not as much of a need for housing those goods as well.
Theoretically, or because you bought a bunch of stuff, you can have a hold it, you can go ahead, so.
Yeah,
Both ways, yeah.
I always assume the warehouse market, but I don't think, is that correct to assume that, hey, if the economy is going well, we would have lower vacancies, and if the economy is not going well, we'll have.
So a lot of things broke during the pandemic. One of the things is all the old relationships necessarily don't. So the trucking industry is going through a recession right now. If you looked at that by itself, just trucking in a warehouse, and said, oh, that pretends that trucking is not doing well, that means the economy as a whole is not doing well. Well, that's not true. It's because there was huge need for trucking immediately after the pandemic. People over-invested in trucking, and all of a sudden things got more efficient, supply chain things worked out. Now you don't need all that capacity. If the trucking is going through a recession, but the overall economy, people are still buying as many goods as they were. In fact, buying more goods than they were before the pandemic. They're just not needing all that overcapacity, which you saw in the trucking market. So yes, you could overbuild warehouse space in the trucking. So problem is we don't have. We're not there yet.
Flex space too.
flex space, medical office space.
Yeah.
As it turns out, if people live there, they need it easily.
For the warehouse, are you talking about those like, where they can rent the different sections of the warehouse? We're talking about the large ones or just.
So the ones we've seen being built for spec tend to be large, very good quality warehouse space.
Yeah, warehouse vacancy go down if there is a slight recession just because of forced downsizing, like say somebody has a 3-bedroom apartment and now they're having to go to a 2-bedroom apartment, they need a place to house and stuff.
So storage space, we are not including storage.
Oh, okay.
So this is, when we say warehouse, this is actual warehouse, not storage space being used as warehouse. We're trying to start tracking storage, but it's a little harder to figure that piece out.
You track Portsmouth warehousing industry is huge in Portsmouth. You do get guys track.
What's not, this has just been in Washington County.
It'll be interesting to see, like, I guess to your point, like how they have fared and, you know.
Yeah, 'cause I'm from Fort Smith is why I passed that, so I've always seen a lot of big changes in there, but I didn't realize mini storage wasn't a part of that, so.
We're tracking the construction of mini storages, the evaluation. We're not tracking vacancy rate, of mini storage yet. So I don't
On
know
the
if it-
storage, the only thing I would add, though, you see national people like U-Haul, you know, they're building 2 right now. So there's a lot of analytics, you know, Spare Box bought 14 of them or something, you know, so if you look at it, they know something or paying attention to something as a growth. You could find a storage unit for under 3 million before, now it's, you know, 7+. You can see it listed for 17 right now. I do wonder about maybe vacancies or, you know, overbuilding that asset class a little bit, but to your point, you know, 13,000 people moving here a year. Maybe was underdeveloped before and it's progressing with population growth.
And I think when we've talked to storage unit owners, we find that they are using it basically, a good chunk of it is being used as warehouse space, it's business inventory, not individual.
And that's probably not the most efficient use for business.
It certainly is
First,
not.
they want big
But
box
that's
height,
yes,
ceilings, typical.
it's just that warehouse segment is underdeveloped in Northwest Arkansas, so they're using storage facilities.
Has size of the new builds gone down in square footage that would?
Warehouses?
No, in single family.
The average single family, well, only in Fayetteville. Fayetteville is probably the only city that started building denser single family houses. The average house in Fayetteville is 1 room smaller, about 200 square foot smaller. Again, not necessarily the primary reason why. Again, people that are buying, at least people who live here, are often buying for the first time. They're not coming with large amounts of furniture that they need to furnish a house. They then have to buy furniture, put the house. So the fact I see everyone's car parked outside, so they're using the garage. So that's.
I would agree with what you were saying, because I live down in Fort Smith and I was looking at renting like a multifamily up here, but the rent prices right around that, probably 1,200, 1,300, maybe 1,400, I would have stomached. But if I would have got up to anything over that, I wouldn't have done it. I ended up renting a house over in Springdale, and main issue was dogs. And like I have a German Shepherd, so you know now they're being labeled by a lot of insurance carriers as aggressive dog breeds. So the other thing I will say is that like as a commercially licensed roofer, anybody that's building multifamily that has a sloped roof system, they need to be putting hail rated products on the roof, or they're going to be running into huge problems when they go to insure. And then last thing I'd say is that there are buyback insurance like Lloyd's of London is offering, which we did a claim in Fort Smith where she would have had $100,000 out of pocket deductible. If she didn't have that, with the buyback insurance, it reduced it down to 10,000. And we actually structured it that when we did the roof for her, we have a transferable warranty, and she's about to do the exit right now to sell. So it's helping with the valuation of the property on the way out. So it's just something to think about because, you know, I mean, it's getting really bad, the insurance market here for.
It's my imagination, we do not have this much shade before, right?
No, it's getting worse.
I owned my house for 10 years. And then just in the last few years, we sort of like get hailed at. This was not my calculus.
And the products are cost equivalent, but a lot of times the problem is that the multifamily are using GCs instead of a specific roofer that knows the product to put on and then is certified in that product to make sure it has that hail resistant. And for low slope systems too, they have products out there too. They just cost a little bit more, but it's worth putting on. you know?
Yeah. It really key. So.
Yeah.
Only thing that we haven't talked about really is that I was gonna say, commercial building permits are very healthy, even the non-Walmart permits there. A lot of car washes.
Oh, my word.
Car washes are a great investment to build in Poland. So if you notice where all the car washes are going, they're basically going around 71B. There is a long-term plan, federal on the front edge of it, to redevelop 71B through 4 big cities. Federal, Springdale, Rogers, Benmore, federal owns 71B right now. Benmore and Rogers probably will likely own it next. Springdale will be last because they need to get that 412 thing solved before they own 71B. But when that happens, you'll have one single corridor that connects the 4 downtowns in Northwest Arkansas. There's a transit plan that is attached to that, which would make all the area on 71B very developable. But if you're where you are right now, just 10, 15 years, probably away from all this coming to fruition. You could build and hold a car wash. Apparently people pay subscriptions to car washes. It wasn't enough to get Netflix. Now have a car wash subscription too.
Very fast appreciation.
Very fast appreciation. If cars are also dirty when I look at them, so I don't know who's using the car washes, but someone is. Or actually what's really happening is you pay for the subscription, you forget about it, you never use it. Which is why those things are incredibly popular. That's a lot of construction, but the one thing we really haven't talked about is the office market, which is, you'll see we've added a lot of office in Northwest Arkansas over the last several years, and the vacancy rate really won't go up. We've also added a lot of nice new retail space, and the retail space vacancy is held flat. Almost all that vacancy rate is in old office space and old retail space at this point, and I mean old retail space, places where people don't want to go anymore. So that's very different than the national picture, where vacancy rates are about 0.2% now nationally. Depending on which market you are, much higher than that. I stole this graph from Cushman and Wakefield. I'll have you know that they put asking rents in the nice bold chart, and then the vacancy rate in the thin green line, which you can't really pay attention to, but that's what you really need to pay attention to, the vacancy rate, is significantly higher. This was a slide from a conference I was at recently about commercial real estate. People were very worried, especially in the larger markets, vacancy rate, and in large part is because, after the pandemic, those whole 2-year period, we all worked from home. Everybody realized that they could work from home. And then you ask them to commute to the office every day. And in places where your commute time is over 45 minutes, office space vacancy appreciably rises for every minute of commute after that. So the longer your commute time, the less likely you are to go to the office. Or if you're going to the office because it makes you come to the office, you're in a hybrid situation where you're not going every day. So in some of these major metro areas, if you hard swipe data, only 50% of the building is occupied. So basically days in the offices. So yes, they're coming in a hybrid situation, but at 50% capacity. So if you look at vacancy rates in places with really long commute times, one San Francisco where you have to drive, or Midtown Manhattan where you can't take the metro. The metro will take a long time to get there from Queens, for example, because it's not very efficient. You see, the longer the commute time, the higher the vacancy rates in those areas. You can see it's broken out by how far. So people with very short commutes are going to the office. People with long commutes not going to the office. This is the average commute time in Northwest Arkansas, some of the peer areas that we compare ourselves to. So basically, this is the percentage of people commuting less than 30 minutes to work. We're doing better than everybody else, with the exception of Des Moines, West Des Moines, Iowa. They have about as good office vacancy rate as we. And they don't have any large, yes, they have large businesses, so they don't have any large institutions moving the office market like you see in this market, but their commute times are really short. Their downtown development is incredibly good. In fact, they had more people move to downtown Des Moines than they had to the entire metro area over the last decade because they've built so much. So clearly we should learn something about condos and things like that from downtown Des Moines. They have the lowest vacancy rate along with us in this bunch. Ours is lower than Des Moines. So we have some different things going for our market. But out of the rest of them, they have the lowest vacancy rate just because they have a lot more people able to get to work faster. Yes.
I think we're, also, yeah, if we can wrap up,
And the only other things I was going to say is that basically, if you think remote work is going away, it's not going away. People are working hybrid. Some people are working remote. Remote work has stabilized about 25% nationally. That's 25% of workers working remotely. And this chart gives you an idea of which sectors you see remote work. So these are the heavy service sectors. They can't work remotely. They have to be in person. But then you look at these things here. These are areas where we are really strong. And this is areas where Northwest Arkansas has very high employment. And those are the areas where you see high amount of fully remote workers or hybrid workers. So keep in mind that our commute times very much matter to our office vacancies. So our office vacancy is incredibly low, in large part because few people have long commutes in Northwest Arkansas. But the home prices the way they are, building patterns the way they are, our commute times have been going up. If you looked at that chart that I had before, which is currently hidden by our picture, that our commute times will manage slowly in Northwest Arkansas. And the longer that happens, the more likely we are to see more vacancy here. And everything I talk about this is basically a measure of distress in the commercial real estate market. The gist of this is that the distress is all in the office market. And it is in very specific kinds of financial institutions. So this is who holds all the commercial real estate loans in the country. The composition of those commercial real estate loans, obviously multi-family, and that's safe in most markets. Banks only make up this portion of it, so they're the ones you care about. It's systemically important to our economy. These are government sponsored, like Freddie Mac, GDO, all those are not going away. These people, if they fail, ain't the people care. So give you another view of this. Again, large banks, the ones that are, systemically regulated by the federal government, the Federal Reserve, they hold very little commercial real estate in their portfolio. Most of the commercial real estate is in this middle-sized banking industry. And again, the commercial CRE, which includes all kinds, including offices, is a significant portion of the community bank sector. That's the one, if anything, you might see some struggles. And this is the commercial loan maturities over time. You'll see that most of the office maturity is happening now and over the next few years. So if you see some regional and community banks, federal property community banks, that would be in places with really high commercial vacancy rates in offices. So over the last several months, there have been a couple of different banks in New York that have been under financial distress because they have a lot of office on their portfolio. Their office portfolio is not performing. They've been bailed out repeatedly by other banks. I probably think it's out in the last slides at some point. Probably going to go into receivership. And then, what you see very surely happening is that there are delinquencies in commercial credit lending obligations here. Those are the same as CDOs. If you guys remember CDOs from 2007, how they fared. Those CDOs were for single family houses. CLOs is just rebranded. Commercial real estate, same thing, same concept, high risk. You can see that those are particularly struggling. The difference between CDOs and CLOs is that fewer people have CLOs, which is why I said that there was a small section that has these things and they don't really care. They will probably fail because those CLOs are currently doing terrible. That's it.
Thank you. I know we had a lot of great questions already, and we're behind, so I don't want to hold anyone. So I guess, what we'll do is, we're gonna basically get towards our closing. And if folks have other questions, stay on chat and do just for sure. And I do want to just share about what's coming up next. Thank you again, Mervin, for speaking today. We don't usually, can get on his schedule because it's so busy flying everywhere. So appreciate you spending time giving back to the community here, investors. And next month, where Brad and I will actually be speaking. We don't usually speak in events, but Brad and I will be speaking. We'll be talking about deal structuring and whether you're a passive or active investor, it's always helpful, structure a deal that's sound for investors and for yourself, and that's set up for long-term success as well. Do you want to add anything about what we're going to be talking about?
Yeah, this is a great one if you're active in or any kind of commercial real estate. I've done over 30 deals as a partner or investor. So Macy has a ton of experience in this. So I think it's going to be a great topic. Yeah, and we just started the LinkedIn page too for the Northwest Arkansas Commercial Real Estate Meetup. So we're going to start announcing more of our great speakers like Mervin there, and really excited for the future here. So
yeah, and if you're not in the Facebook group, feel free to use that QR code to sign into the Facebook group. We do stream live in the events as well, in case you can't make it sometime. You can watch the streamed version. And I do want to mention, just briefly that our next event sponsors, Equity Bank and Walker and Download. They're both great debt service providers as well. We also have Alex from Equity Bank that he'll share a little bit more about, what they do in the next meetup as well. So if you have any feedback, feel free to share with Brian now. We're very open. We want to give back to the community workshops like this. So that wraps it up.